If you've ever had money sitting in a savings account and thought, I should probably be doing something with this video is for you. Maybe you've asked yourself, is $5,000 even enough to start? Do I need more before it's even worth it? What if I invest and the market crashes tomorrow? What if I pick the wrong ETF and lose everything? What if I'm already too late? In this video, I'm going to answer every single one of these questions, step by step, starting from zero. What exactly are ETFs? How do you choose the right ones? How can you build a real portfolio with $5,000? And exactly how do you buy it today? In the end, I'll show you two things. One, how John turns $5,000 into a $250,000 portfolio with 3 ETFs and no additional contributions. And two, a bonus portfolio where 2 changes to that same portfolio turn the exact same $5,000 into a portfolio worth over $600,000. But before we build anything, John needs to understand what he's actually buying, because most people who've heard the word ETF couldn't explain it in one sentence, and that's not their fault. The financial industry has a habit of making simple things sound very complicated. So let's fix that right now. An ETF, short for exchange traded fund, is basically a basket. That's it. Instead of buying one company and hoping it works out, an ETF lets you own hundreds or even thousands of companies all at once. One purchase, instant diversification. If one company inside the basket has a bad year, the rest carry it. Now, how is that different from a stock or a mutual fund? Well, a stock is ownership in a single company. If you buy Apple stock and Apple has a terrible year, you feel every bit of it. The upside is higher if you pick right. The downside is just as steep if you don't pick right. Look, most people don't pick right consistently, and the ones who do get lucky more often than they'd like to admit. Now, a mutual fund is also a basket, but someone is managing it for you. A fund manager is making decisions about what goes in and what comes out. That sounds helpful until you see the fee. Actively managed mutual funds typically charge 0.5 to 1.5% per year taken out of your investment, whether the fund goes up or down. Over 30 years, that fee becomes one of the most expensive things in John's financial life. An ETF splits the difference. It's a basket like a mutual fund, but nobody's managing it. It just tracks an index, the S&P 500, the NASDAQ, the global market. Whatever the index does, the ETF does. No guesswork, no manager making calls with John's money, and the cost reflects that. The ETFs charge between 0.03 and 0.3% per year, a fraction of what a mutual fund takes. And that one number, the expense ratio, is the most important thing John checks before buying any ETF. It's the percentage taken out of his investment every single year, regardless of performance. A fund charging 1% a year takes $10 out of every $1,000 John has every year, whether the market goes up or down. Every ETF in this video has an expense ratio under 0.2%. It's the first thing John looks for, and it's the first filter we're going to use to build his portfolio. So, expense ratio is filter 1. But there are 2 things John checks before putting a single dollar in, and they're just as important. The second thing John looks at is what the ETF actually tracks. 2 ETFs can both call themselves index funds and own completely different things. One might own 500 companies, another might own 8,000. One might concentrate entirely in technology, another might spread across every sector in the global economy. The label doesn't tell you what's inside, the index does. So before buying anything, John asks one question about every ETF he considers. What does this actually own? Not the marketing description, not the fund name, the underlying index. And what's in it? If you don't know what an ETF tracks, you don't know what you're buying, and you won't know why it's going up or down when it moves. That matters most when the market drops and John needs to decide whether to hold or panic. Knowing what's inside the fund is what keeps him from making the wrong call at the wrong moment. The third thing John looks at is track record, not past performance as a guarantee of future results. Every fund disclosure in the world will tell you that, but consistency over 10 to 20 years as a signal of stability. A fund that has been through the dot-com crash, the 2008 financial crisis, the 2020 pandemic, and recovered from all of them is telling John something. It's telling him the index it tracks has survived real market cycles, that the companies inside it have proven they can come back, that the structure of the fund itself is tested and trusted. John isn't looking for the ETF that performed best last year. He's looking for the one that has shown up consistently over decades, because that's the timeline he's actually investing in. So there are three filters. 1, expense ratio under 0.2%. 2, know what it tracks. And 3, proven track record across multiple market cycles. Every ETF in the starter portfolio clears all three. Here's how John builds it and the reason behind every decision he makes. This starter profile is built around 3 ETFs, each one chosen deliberately, each one with a specific job inside the portfolio. Before we get to how John splits his $5,000 across the 3 ETFs, let's talk about what each fund actually is and why it belongs here. The first fund is VOO, the Vanguard S&P 500 ETF. VOO tracks the S&P 500, which is an index of 500 of the largest publicly traded companies in the United States. Apple, Microsoft, Nvidia, Amazon, Berkshire Hathaway, and 495 others. When John buys VOO, he owns a piece of all of them simultaneously. Not a bet on one single company, ownership of the American economy's largest and most established businesses in one place. The index is weighted by market capitalization. This means larger companies make up a bigger share of the fund. So when the biggest companies grow, John's VOO grows with them. On the other hand, when a smaller company in the index struggles, it has less of an impact on John's portfolio because it represents a tiny fraction of the total. Expense ratio is at 0.03%, the cheapest fund in this entire video. Average annual share price appreciation, 13.17%. VOO passes all 3 filters without hesitation: the lowest cost, the most trusted index in the world, and a track record that survived the dot-com crash, the 2008 financial crisis, and the 2020 pandemic, recovering from every single one. VOO's job in this portfolio is stability. It's the foundation that everything else is built on. The second fund is QQQ, the Invesco NASDAQ 100 ETF. QQQ tracks the NASDAQ 100, the 100 largest non-financial companies listed on the NASDAQ exchange. Technology dominates here. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla sit at the top. Technology makes up over 50% of the fund. Consumer discretionary and communication services fill in the rest. The expense ratio is under 0.2%. The average annual share price appreciation sits at 19.13%. The difference between QQQ and VOO is concentration. The S&P 500 spreads across 500 companies in every sector: financials, healthcare, energy, utilities, technology. The NASDAQ 100 concentrates in innovation-driven companies. And that concentration is why QQQ has historically outperformed the S&P 500 over long time periods, and why it also falls harder when technology has a bad year. John isn't buying QQQ for income. He's buying it because he wants more than what the S&P 500 alone delivers. QQQ's job in this portfolio is acceleration. VOO is the floor. QQQ is what pushes the ceiling higher. The third fund is VXUS, the Vanguard Total International Stock ETF. VXUS tracks over 8,000 companies across developed and emerging markets outside the United States, Europe, Japan, the United Kingdom, China, India, Brazil, every major economy except America in a single ETF. Expense ratio, 0.05%. Average annual share price appreciation, 6.56%. Dividend yield, 2.86%, the highest in this portfolio. So international stocks don't always move in the same direction as U.S. stocks. When U.S. markets struggle, and they will, in cycles, international markets sometimes hold steady or grow independently. That's geographic diversification. John's portfolio isn't entirely dependent on the United States having a good decade, and over the long run, there will almost certainly be stretches where it doesn't. The appreciation rate is the lowest of the three funds. VXUS is not the growth engine, its job is balance. At a small allocation, it won't drag the overall return, but it provides something neither VOO or QQQ can, and that is the rest of the world at almost no cost. The U.S. market has led the world for the past decade. It won't always. VXUS makes sure John is covered either way. 3 funds, 3 jobs. And here's how John splits his $5,000 across them. Half goes into VOO, $2,500, because that's where the stability lives. The other 2 funds can take more risk because this one doesn't have to. QQQ gets 30%, $1,500, enough to meaningfully push the long-term return above what VOO alone delivers without making the whole portfolio rise and fall with the NASDAQ every quarter. And VXUS gets the remaining 20%, $1,000. And it's not a token allocation, it's a real position that adds geographic balance without diluting the growth story that VOO and QQQ are building together. John's total investment is $5,000. One time, nothing added after day one. Across the 3 funds, the portfolio blends out to a 1.27% dividend yield, a 7.24% dividend growth rate, and an average annual share price appreciation of 13.64%. That's the number that does the heavy lifting over 30 years. In a couple of minutes, I'm going to show you how John's starter portfolio could grow to over a $250,000 portfolio valuation from his original $5,000. Then I'll show you a bonus portfolio where 2 changes to that same portfolio turned the exact same $5,000 into a portfolio worth over $600,000. But first, let's discuss what to do once you've selected the ETFs for your portfolio. So John has his portfolio. Now he needs to know how to actually buy it. This is the part most investing videos skip. They tell you what to buy and never actually show you how. So let's fix that right now, because the actual process of buying an ETF is simpler than most people expect. Just 3 steps. That's it. The first step is opening a brokerage account. This is where John's ETFs will live. Think of it like a bank account, but instead of holding cash, it holds investments. For a beginner John's age, Fidelity, Schwab, or Vanguard are the right options. All 3 are free to open, no account minimums, no monthly fees, and all 3 support every ETF in this video. The process takes about 10 minutes online. A name, an address, a social security number, and a bank account to link. That's everything required. The second step is funding the account. So John transfers $5,000 from his bank account into his new brokerage account. Most brokerages process the transfer in 1 to 3 business days. The money doesn't need to be invested immediately. It sits as cash until John is ready to buy. One thing worth doing before buying anything, turn on automatic dividend reinvestment. It's usually a single toggle in account settings. When dividends are paid out, and every fund in this portfolio pays them, Instead of sitting as cash, they automatically buy more shares. Free compounding that starts from the first dividend John receives and never stops. Turn it on once and just forget about it. The third step is buying the ETFs. John searches the ticker VOOQQQ VXUS, enters the dollar amount he wants to invest in each one based on the allocation, confirms the order, done. The whole process from search to confirmation takes under 5 minutes per fund. One important note for anyone watching this who has less than $5,000 right now, most major brokerages support fractional shares. That means John doesn't need the entire amount to buy one full share of VOO at whatever it's trading for today. He can put in $50, $100, $500, whatever he has. The brokerage buys the fraction of a share that amount covers. So the minimum you can contribute isn't a specific share price. The minimum is whatever John has available to invest right now. That's the entire buying process. No special knowledge, no financial advisor sitting across a desk. If John can order something online, he can buy an ETF. It's that simple. Now the most important question, what does John actually do next? This is the part most people get wrong. John has his portfolio. The ETFs are purchased. The account is funded. And now every instinct he has is going to tell him to do something. Check the balance, react to the news, move money around when one fund is outperforming the other. That instinct is the most expensive thing in investing. What John actually does, however, is nothing. He doesn't check the portfolio every morning. He just lets the portfolio do what it was built to do and gets out of the way. 3 things specifically. The first is holding through the drops. The portfolio will go down. Not might, will. 20%, maybe 30% at some point. Every major downturn in history, though, has been followed by a recovery. The investors who lost money permanently weren't the ones who held, they were the ones who sold and never got back in. John holds, no matter what. The second is letting dividends keep reinvesting automatically. John set this up automatically before he bought his first share, but it's worth understanding why it matters. Every quarter, the funds in John's portfolio pay out dividends. Without automatic reinvestment, that cash just sits there doing nothing. With it, those dividends immediately buy more shares. More shares generate more dividends next quarter. Those dividends buy even more shares, and that cycle runs in the background. The third is reviewing once a year. Not once a week, not once a month, just once a year. John opens his brokerage account, looks at his allocations, and checks whether the balance between VOO, QQQ, and VXUS has drifted significantly from where it started. If QQQ has had a great run and now makes up 45% of the portfolio instead of 30%, John rebalances, sells a little QQQ, buys a little VOO and VXUS, and brings the allocation back to where it was originally built to be. If nothing is shifted dramatically, John just closes the app and goes back to his life. Listen, that's the entire maintenance plan. 1 check per year. Rebalance if needed. Everything else, leave it alone. Now, here's what the future projections look like when John follows these steps. So we know John put $5,000 into the starter portfolio one time. Based on the projections, year 1, the account sits at $5,745. That's not a typo, it's only been 12 months. The $745 gain is the first sign the money is moving, but compounding hasn't had time to build on itself yet. This is the part most beginners misread. Year 1 looks slow, because it is slow. What matters isn't what year 1 looks like, it's what year 1 starts. By year 10, the account will grow to $19,529. John hasn't added a dollar since day 1, and his $5,000 is now approaching $20,000, nearly 4 times what he started with. The compounding is building momentum now. By year 20, the portfolio reaches $73,239. John is somewhere in the middle of his career. His one decision made years ago with just $5,000 he wasn't sure was enough is now sitting at over $70,000. The same dollar that took 10 years to become $19,529 took the next 10 years to become $73,239. Then year 30 lands at $268,954, $250,000 from a one-time $5,000 investment. Total value added over 30 years, $263,954. Capital appreciation drives $257,930 of that, the blended 13.64% average annual appreciation doing its job across 3 decades. Dividend reinvestment adds another $6,024 on top. That's the automatic reinvestment John set up on day one, running in the background for 30 years without him touching a thing. But what if John wanted more than $250,000? What if he was willing to take on more risk and push that same $5,000 even further? Same starting point, same $5,000, same one-time investment, but with 2 changes to the starter portfolio, and the year 30 number looks completely different. This is the aggressive growth portfolio, and it's not for everyone. It's not designed to be. It's for the investor who has a genuine 30-year timeline, who understands that more growth means more volatility along the way, and who also won't panic when the portfolio drops hard in a bad year. If that's not John, the starter portfolio already has his answer. If it does sound like John, well, here's what the numbers look like. 2 things changed from the starter portfolio. Number 1, VXUS is out. The global diversification layer gets replaced entirely by VGT, the Vanguard Information Technology ETF. VGT tracks over 300 U.S. technology companies. Apple and NVIDIA alone make up over 30% of the fund. Semiconductors, software, hardware, IT services, pure technology, nothing else. Expense ratio is 0.09%. Average annual share price appreciation, 21.54%, the highest of any fund in either portfolio. VGT's job here is one thing and one thing only: maximum long-term growth. It does that job better than anything else in this video. It also drops harder than anything else in this video when technology has a bad year. That's the trade. With this aggressive growth portfolio, the allocation also shifts to reflect the higher risk profile. VOO drops from 50% to 40%, so $2,000. Still the anchor, slightly smaller to make room. QQQ steps up from 30% to 35%, $1,750. More NASDAQ concentration, more growth engine. Then VGT comes in at 25%, $1,250, the most aggressive position in either portfolio, doing the heavy lifting on the growth side. Across the 3 funds, the aggressive growth portfolio blends out to a 0.71% dividend yield, a 6.26% dividend growth rate, and an average annual appreciation of 17.35%, the highest blended appreciation of either portfolio in this video. Here's what that portfolio looks like over the long run. Year 1 comes in at $5,903, a slightly stronger start than the starter portfolio, the higher blended appreciation already pulling ahead in the first 12 months. By year 10, the account grows to $25,716. The starter portfolio sits at $19,529 at the same point. That's a $6,187 difference from the same $5,000 inside the first decade, and the gap is only going to widen from here. Year 20 hits $128,850, nearly double what the starter portfolio produces at the same point. 2 decades of concentrated technology exposure compounding and the distance between the two portfolios is now impossible to ignore. Then year 30 lands at $640,401. Starter portfolio, $268,954. Aggressive growth portfolio, $640,401. The gap between them is $371,447 from the same $5,000. Same starting point, same timeline, same one-time investment. The difference is the risk factor. How much risk is John willing to stomach?